supply and demand fundamentals have never been stronger. It's just a very curious little sort of sub-note, if you will, or side note to this most recent correction in gold.
Yeah, actually it's a very important side note. It's not that little. And really, it's a very good point to differentiate between the kind of investments. I always get the question, about mining stocks, especially this year. Mining stocks really underperformed the metal. And then you've got the ETFs that supposedly invest in gold and silver. And I say supposedly because they really don't. These are all paper instruments, and you don't actually have gold or silver in some of these. So people have to be very choosy, and I think that the kind of buying that you're talking about, which is Krugerrands and actual gold and silver, that's very important. That's buying for safety, and that is a really very strong investment buying. And they're not the speculators that want to buy today and sell tomorrow. That's a very good point, because I think that really shows you the longer-term trend. They are much more serious about their investments than people who buy the ETFs or gold futures, let's say. So I think it really, in a way, confirms the long-term bullishness of the gold market.
It looks like that 30-year of an inflationary trend with a retracement here and there in the midst of it. One of the things that we're finding is the math simply doesn't work anymore. We've already, in spite of having 20 years of deflation, we've still expanded our monetary base and our credit base significantly, dramatically, not just the last 6 years, but even the last 20 or 30, relative to the stock of gold and silver that's been mined. There's about a 1.6% inflation rate with the gold stock. That's new mine production, about 2,700 tons to 3,400 tons a year, depending on the year. If you compare that inflation rate to the monetary inflation rates, which, as you mentioned earlier, right now are running between an 8.8% if it's a 92 measure using the 1992 modeling, or a 12.6% if you're using the earlier model, Bureau of Labor Statistics put together in 1983, the numbers just don't work. There's not enough gold, should there be any demand for physical metals, there's not enough to go around in light of the dollars that are out there. $2 trillion worth of gold that's ever been mined.
Now, in the last bull market, it was primarily, I believe, a U.S.-driven gold bull market in the 1970s. This time it's global. And, people in the Middle East, people in China, they have so much money. And China still has to diversify a lot of its assets into gold. And the Chinese government keeps on buying gold. And I think especially when they start recognizing the big problems, the financial problems that are out there, that the only alternative is to cheapen paper money in order to reduce the real size of this pyramid of debt, they will say, hey, gold is the only choice. And, China has, $2 trillion of foreign currency reserves? That's huge. And the gold market is very small.
$2 trillion total that's ever been mined,
right,
in the history of the world.
Yeah. So China could buy it all with what they have, with the money they have.
One question, just bringing this a little closer to home, we look at housing, and housing has been a major component. If you look at the combined wealth of Americans between what they have in stocks and what they have in their own homes, it's roughly $30 trillion in total value. We began to see a nosedive in equities and bear market the early part of this decade. Now it looks like we've got a resurgent trend there where we are going into a nasty bear market in stocks. At the same time, though, we have our home prices dropping. This is reminiscent of something maybe we saw in the 70s, where you had the worst of both worlds, and that had a very negative effect on the psychology of the American consumer and their penchant to buy things. They really tightened up their belts a bit. Maybe the housing market is actually recovering. And certainly I listen to CNBC every day. That's the message I'm getting. I'm guessing you have a different opinion.
That the housing market is recovering?
Yes.
Well, there are a lot of bargain hunters buying foreclosed properties, and you can even buy some houses, from what I heard, for $1 for the house in Detroit or someplace. I think there's a huge surplus still to be worked off. We had a 6-year period where builders increased the housing stock by 20% a year. There just is not that much demand. So we had really every year 50% more houses built than could be absorbed by the market. And so that has to be worked off. They're still building, although inventories are 11 months of demand. So that has to be taken care of. I know other real estate recessions. Usually somewhere 3-4 years down the road, there's a bottom. If we think this one started, let's say, 2 years ago, then somewhere in the next year to 2 years, we should have an intermediate-term bottom. And that will create the killer wave because you're going to have everybody going out there buying up the bargains, and the rally will last maybe a year and a half, and then you get the next down wave, and that's down another 50% in prices. And that is the killer wave.
So you think that actually 2010 to 2012, you could see an uptrend in housing followed by one of the most vicious downturns and something that actually is sort of the final cathartic washout in the housing market.
That's right. That's the way it usually works.
So 2010 to 2012 would be the equivalent of a dead cat bounce if you were charting it.
Yeah, and that is the one that really gets all the people who were careful in 2006 and were not caught up in the frenzy. They're going to be caught up in that bargain hunting wave. And I remember a big developer in Texas, he told me in the late 1980s, he said, in 1980 we knew everything was way overpriced and we were sellers. But what really got us was 1984, and he said, we're buying properties at 50% of replacement cost. He said, how can we possibly go wrong? And it looked so good for about a year. And then came the next wave down, and prices went down another 50%. And he said, and that's what got everybody.
So that's where most of the bankruptcies occurred for your speculative buyers.
Right.
Once again, you're listening to the McAlvany Weekly Commentary at McAlvany.com. That's McAlvany.com.
Well, I'm curious because if you look at the long-term interest rate trends, it looks like we could actually be bottoming. And if we're entering into a 30-year inflationary period or already have, we would expect interest rates to be moving up. Looks like a multi-step sequence, if I'm hearing you correctly. Let's say, for instance, right now the Fed is beginning to fixate on inflation, and maybe they're fixating a little too late, but that keeps interest rates up, not down, for the time being. Could it be that 2010 to 2012, what you see as an upsurge in housing, coincides with more accommodative rates from the Fed?
Well, the Fed actually, let's take a look at what interest rates should really do. Interest rates should be set by the marketplace instead of the Federal Reserve. That's the major problem that we have. The Fed kept interest rates too low, too long from 2003 to 2006. Mm-hmm. And that created this gigantic credit bubble that we had. Then they raised interest rates 17 times in a row and so on, which was overdoing it. The Fed should not be in the business of price controls, and controlling interest rates is really price controls. That's a system that Russia tried for 75 years, where they had a committee that determined how many pairs of brown shoes should be made, how many pairs of black shoes, and how many different models of cars, thinking that this committee of geniuses was much better in deciding than the marketplace. Well, the